28th of June, Wednesday, MAO with Cal once again. Now, is USA entering a rolling recession? Now, this is something new to me, honestly. I mean, we know what's recession, depression, deflation, stagflation, but rolling recession, well, that's a new terminology for me, and I realized that it's actually there. I'll tell you more in details. Let's continue, all right? Disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. All right, let's go into what happened last night. Now, the Dow Jones recovered 212 points last night, NASDAQ up by 256. Now, I already remember telling you guys that the NASDAQ, the Dow Jones will recover a little bit because it's down by 6-7 days. Usually for a bull market itself, that is where it will stretch and a technical rebound will usually happen. So last night, Microsoft up by 1.82%, Amazon 1.45%, NVIDIA up by 3%, same with Tesla. So is it the start of the new upside once again? Well, I'll tell you more in detail shortly, but let's go into detail from CNBC. S&P and NASDAQ rally more than 1% as tech leads turn around. All right. So what happened? Let's take a look here. First of all, Dow Jones rose on Tuesday for the first time in 7 days as Wall Street traded for the end of the first half and investors power back into the tech stocks. Okay, that's one reason. And of course, those AI names like NVIDIA, Meta, Microsoft basically all went up. And of course, we also saw Delta Airline went up by 6.8%. Okay, because of their financial guidance. Yeah. All right. The only thing is this, we have the Walgreens down by 9.3% because of weaker than expected earnings. I'll talk about these earnings on the smaller company, and it's going to be very important. But very incredible is that there's some resilience in the economic data. The May durable good data unexpectedly increased. Wow, that's fantastic. And consumer confidence improved. Wow, again in June. So and even new home sales top expectation. So what happened is right now, seemingly, although we know that we are impending, there's a pending recession, but the thing is this, the economy seems to be on a solid footing and the odds of recession decrease from every piece of economic data. Now, this is something I'm going to ask you. I mean, yes, yesterday data was all very beautiful, but that is not going to help from the manufacturing side. But again, people don't realize that, right? The manufacturing industry, the sector itself, right, actually is not strong or not, in fact, doesn't take a big piece of the pie. I'll tell you more in detail very shortly. And then with that information, we realized that the NASDAQ has gained 10.9% since April. And overall, for this year alone, up by nearly 30%. Now, this is definitely on pace, one of the best first half of the year in 40 years as technology investors went into the technology stocks, okay? And of course, for the S&P and Dow, they are up to, for the quarter, 6.6 and about 2% respectively. So overall itself, right, is this a start of the bull market? Well, let me share you with more details. So let's look at this. Now, what we have is incredible. The core durable goods order came 0.6% in surplus, and that is way higher than the forecast of minus 0.1%. The consumer confidence up by 5 tick, in fact, 109.7. Wow, the forecast was 104, while the previous was 102.5. So again, is it because everyone believed that this is going to be the start of the bull market and new home sales increases by almost 70,000? That's a lot. So with the price coming down, is that the reason why people are buying the houses? Is it because right now the stock market is staying afloat? That's why people are confident? Well, all these things ongoing right now. So the interest rate that the Federal Reserve is hiking doesn't seem to really dampen the mood. So does it mean that, right, the Federal Reserve have a lot of room to increase interest rate? So we'll talk about this shortly. Now, tonight, Jerome Powell will be speaking. So watch out for that. That'll be about 9:30 p.m. Singapore time. And after that, he'll speak again tomorrow at 2:30 p.m. Singapore time. That's interesting. Okay. All right. So we'll talk about that later. Or it's 2:30 p.m. Singapore time. That's interesting. That's 2:30 a.m. Singapore, I mean US time. Okay. All right. So the GDP quarter on quarter will be out, and the market is looking at slightly lower number because the previous was 2.6%. If this is going to be 1.4 or lower, that will actually send some negative vibes to the whole entire market. All right, so before that itself, you can see that the consumer confidence back then during the pandemic time, it went as low to about 85, and today we're at 109. So look at it itself, seemingly things are getting better. Now, the thing is, based on my TWB chart itself, we have a few days of downside, which we tell you guys to take profit. where the market was trading down here, we asked you to take a sell position. Remember, I told you guys there will be a peak movement between 13th to 15th of June. It really happened. Good for you guys. And then around some area like this, we mentioned to you it's time to book some profit because we realize that the boys are still buying. The momentum is still very positive. Even the KRW is going for the buy. So that's the reason why yesterday we already tell you that to buy back some of your short position. Hopefully you remember that. Now, very important is that it's staying above the MA30, which is now about 33,850 area. So now the market is staying above it. So again, that's the reason why the market is still not ready for sell-off. Only when the KSI turns red and the KRW turns red, and then of course if the KCX also turn blue, that will be the right signal for a potential sell-off. So at the moment now, as long as market stays above the MA30, it's kind of difficult for the market to come down. So consider to take profit unless the market breaks below the MA30. Now, the thing is this, foreign buyers are also unloading bonds, right? They've been buying the bonds market because of the yield. Now, the thing is this right now, because of the yield now, is likelihood is going to continue to it may fall in about 3 to 3 months time when the Federal Reserve decide to hold their so-called rate hiking. And if that case is out, right, that is reason why traders may take this opportunity to take some profit off the table. All right, we can see right now that the treasuries also have been selling about 162 billion in securities, which they needed for their for the entire running of the government operation. So what we are seeing right now, the yield is definitely very attractive to some people. We all know that the Treasury Department need to refill the TGA account. So that's why we know that there will be a lot of sales. So in order to buy that, usually there'll be some profit taking on the equity market. And I think that this is the one reason to watch out for. So at the moment now, you can see the foreign buyers shed 140 billion in holding in April compared to a year ago. And of course, the bank also shed off about $210 billion of treasury securities. And of course, we know Federal Reserve also been offloading. So all these, the money must go somewhere. And that's the reason why we feel that, all right, the market itself, right, could be looking to move towards cash as holding, while stock market itself is kind of at a high at the moment. So with S&P trading at a valuation way above the historical average, it's kind of difficult to convince anyone to buy in, because at the moment now it's about 21 for the PE ratio. So the average itself, we can see is about 16. Now 16 is a very good PE ratio to buy into the market, and the potential upside itself is about 40 to 50%. So that's the reason why at 21, it doesn't seem to work for me, as I can see from here. Now, the thing is that in the last few highs where the market hit about 23, that was where the market went into some serious selling. So that's the reason why I feel that maybe it's time to really book some profit than jumping in right now. But of course, again, if you're doing speculative trading, that's not an issue, because Goldman Sachs strategy says that the stock returns is staying flat and flat, okay, over the next year itself. They expect the market to virtually no profit growth this year. Wow, it's a very big statement from Goldman Sachs. All right, thing is this. White House recently have redefined the word recession, all right? And remember that created a lot of talks over on town, but at the end of the day, White House insists that recession is not meant like that. Okay, fair enough. So I realized it's another word in the market called rolling recession. So apparently, multiple sectors of the US economy, autos, housing, manufacturing, to name three, have experienced what could qualify as a contractions. And it's possible that others could follow suit without tipping the headline GDP numbers negative. Now that makes some sense, because we can see that the economic figures are not doing any well, but the stock market is still moving up. Because of that, the market believes that recession is not around the corner. But as a fundamentalist, we all know that we are actually there. But why aren't we coming down? So that is the reason why that is about certain sector that's inside here. And that is called a rolling recession. All right. So Morgan Stanley, Mike Wilson says that risk for a major market correction have rarely been higher. So he's still saying that the market will come off, right? But basically majority of the Wall Street, including Michael Harnett, is already more towards the buy side. But Mike Wilson staying on his sell side. Though he had reduced his sell view, but the thing is this, he is still thinking that a major market correction is just around the corner. So even HSBC this morning has came out and says that a US recession is coming this year, with Europe to follow in 2024. Now, I beg to differ. I believe that Europe itself will definitely be the one that will get hit first, then followed by US. But I can be wrong, because based on what we're seeing right now, the whole sentiment now in Europe is very different compared to US. And of course, this British banking giant says that, right, there's a lot of this recession warnings right now are flashing red for many economies, and they feel that there will be some selling. In fact, they believe that by the fourth quarter, right, there will be a contraction and a recession for Europe in 2024. Now, I've been saying this quite a bit for time already. I've been saying that by August, September, we will definitely enter a recession. So in this case right now, HSBC seemingly is also kind of agree with me on this. So to some people, this could be a great opportunity for policymaker to cut rates, and of course cutting rate itself will definitely bring the market down a little bit, because that will send some fear. But then after that, when things are good and cheap, it's time to reinvest, right? So for me, I believe that a pullback will be good so that we can buy cheap in the later part of the year. What do you think? Let me know in the comment box. Yeah. So what we can see right now, they are saying that the coming recession scenario will likely be what happened in the 1990s recession, with the central scenario being a 1.1 to 2% drawdown in the GDP. All right, so they believe that, right, at the moment now, the rapid tightening of the financial condition has caused a downturn in the credit cycle, and market do not appear to be pricing a particularly pessimistic view of the world, which means that if everybody is still so optimistic while the economic figures are actually coming down, then usually this will basically a typical cocktail of a potential recession. So that is what HSBC guys are saying right now. Now, to me, is that the manufacturing data is not as good. Dallas Fed manufacturing, the business condition remained negative for 14 straight months. This is something that, no, I cook it up, it's all real and figures. In fact, it's all right. People are saying that now because it's up by a 5.9, so it's okay. But you must understand, it's still negative. And of course, you can see right now is that although it uptick, right, but overall itself is still down. And this is not a good sign at all, because we're in a negative zone. But the thing is this, people are actually putting that aside. Even the Texas Manufacturing Outlook Survey Production Index has dipped below the 0 mark again, and this is not good. It was the second time we're dipping in. The last time we see something like this was back in the pandemic period, and of course, again, it happened again in 2016, and of course, both incidents, the stock market down by 15 to 20%. So at the moment now, you can see the production, the shipments, the employments are all going downhill, and people are still thinking that this is fine. So again, it's a bullishness able to compensate, or the bullishness covering the bearishness. We let the market decide, because now we can see that the ISM manufacturing versus service index, this clearly shows the manufacturing index is now really at the bottom side. And of course, as we see in the past, whenever this happens, recession is always around the corner. So the thing is this right now, why aren't we in a recession? Because services is still not able to come down yet. But of course, the point is this. The key thing is that because services actually takes only, services takes about 77.6% of the between them itself. So the breakdown of US economy, manufacturing only take 22.4, while services take 7.6. So definitely, as long as services stays afloat, it's kind of difficult to give that recession call. But nonetheless, with the manufacturing data like that, it is very clear that US is not going to benefit from this. So you can see right now, the GDP figures are still at positive, but we can see that it's lowering. So if the data come out and it's like basically below 1%, that will be a problem, because we can see whenever the thing is that it's up to go downwards, right? And it hit 1%, we all know that usually could be the start of the potential recession. So that's why I say that we are very near, we're 3 months away to 4 months away from this move. And I think that traders should be very careful, because now we can see from this chart here, the 10-year US Treasury yields curve between the 2 years and 3 months, we can see that this is the inversion, and that was happening back in October 2022. And usually 8 to 12 months from the first inversion, we can see a potential recession. So if you look at the numbers, right, let's say 8 months, then definitely we're talking about June now, this period. If not 12 months, it'll be in October. So regardless, right, we should have a recession between September to October, and that's the reason why there is a chance of a rolling recession coming in. And of course, using the data from the let me bring you the Federal Reserve Bank of New York, right? The probability of the US recession predicted by the Treasury spread. Oh my God, take a look, guys. This is really insane. We are now a 70.85% level. We are right here. And of course, you look across the board, You realize that since 1961, there were only 2 occasions that this happened. And of course, both occasions will lead to recession. So again and again, this is something very clear that they can lie about it, or they can change the numbers or change the facts of how they redefine certain things, but you cannot run away from fact and figures. So that's the reason why I still believe that you guys should go slow with your investment. I know that a lot of schools are calling for buy right now. They believe that the market's going to go higher, but to me, it's all right. I think we should just go slow. What do you think? Let me know in the comment box, yeah? And of course, with that information, I would like to show you the Fibonacci figures now for the Dow Jones. Now, Dow Jones last night recovered, right? It stays back above the 33,790. Now, this number is the 50%, the 61.8 level, all right, based on the Fibonacci on the recent high to the low itself. So as long as the Dow stays above the 33,790, there's no much worry to be there. In fact, the upside potential could really stretch to 35,182 if the market decided that it's no, let's don't care about whatever happened, let's buy and buy and buy. The Dow can go to 35,182. But of course, if the Dow breaks below 33,790, then a free fall back to 32,813 is really very possible. So the downside itself almost 900 points, and the upside itself, right, is about 1,400 points. So some people say that is a good bet, right? So I leave it to you to decide. But for me itself, we can see that every time the market hit those Fibo figures, the market really, have its incentive to rebound or reject. So that's the reason why I think 33,790 is a very, very important trading level to watch out for. Traders should really watch it, and hopefully, right, you can benefit from this as well. Now I got 2 more charts to show to you, and these are very incredible divergence that you really need to take a look. Now this is the Russell 2000 ETF versus the Nasdaq. Now you can see back in year 2008, 09, and 10, you can see that the way the both of them move in tandem, right? Move in tandem. You can see they stick to each other like glue, and where the market bottom, they are all there. Okay, so you can see that it's a very, very relative index between both of them. Their relationship is very good. So it's because the smaller companies, right, definitely is represented by the Russell 2000. So as long as the smaller company itself is also benefiting from the market, definitely the Nasdaq and this Russell 2000 will move together. All right. So what if they decided to move differently? Now take a look here yourself, guys. This is the how does it look, the Russell 2000 ETF. All right, take a look, guys. Now all the way since the start of 2020 until now, okay, 2021, in fact, they have been moving in tandem. You can see that they move in tandem very nicely. They even peak at the same time, right? Every pullback itself, they move in tandem, very good. But something's changed recently. Ever since March this year, whereby of course Jerome Powell and friends pumping a lot of money in the market again, you can see that the Nasdaq itself, right, is moving on its own, while the Russell is not really followed. So the thing is this. Is it because that the FANGs are the one that are being pumped up while the remaining are suffering due to the interest rate factor? I think that is a main driving thing here as well. So if the smaller company aren't benefiting from whatever's happening, what if the market suddenly pulls back? What if the FANGs have to take profit? Do you think that what happened to the Russell 2000? Do you think what happened to the rest of the whole, all the counters? That is my worry. So from here itself, right, this incredible divergence shows that the market has purposely, focused on the FANG counter just to hold up the market. So of course, probably they're doing this to make sure they maintain the consumer confidence, maintain the Wall Street sentiment. But the thing is you cannot deny that the companies, the small companies ain't benefiting from the current situation. And of course, they may try to go lower again. And of course, when that happens as well, you cannot have too far away divergence. Eventually, this will pull back. And when that happens, those people who've been buying now will freak out. And I tell you this may not be ending nice. All right. So let me know in the comment box. Let me know what you think. So I wish that all goes well for all of you. This is Cal signing off. Take care. Have a great day. Bye-bye.